Today, we're diving into a topic that's crucial for every Indian business to understand. How to avoid becoming a non-performing asset or NPA in India. Usually when it comes to NPAs, many people feel that 90 days overdue is the only way of becoming an NPA, which is not true, as there are many other ways. In this video, we will also cover the very less talked about topic of the ways in which a project loan can become an NPA. Hi, my name is Yash Shah and I am part of the leadership team at SJA, a premier name in the field of integrated services for stressed accounts, from preparation, appraisal of restructuring packages for revival, enterprise valuations to facilitate the decision making, documentation in terms to the restructuring agreements, and monitoring the package implementation as a concurrent auditor or as an ASM, and furthermore facilitating the exit when the restructuring or nursing package comes to an end, and so on. So let's get started. First things first, what is an NPA? All loans extended by banks are assets for them, as they will generate future economic benefits or income for the bank. Such an asset becomes non-performing when it ceases to generate income for the bank. So the question to ask is, when does an asset cease to generate income? This depends on the type of advance extended. We will discuss NPAs under various categories. The categories are as under: fund-based working capital, first of all, cash credits or overdrafts. A cash credit or an overdraft account becomes a NPA when it becomes out of order. That is, one of the below things happens. Number one, the outstanding balance remains in excess of the sanctioned limit or the drawing power, whichever is lower, for a continuous period of 90 days, or there are no credits in the account continuously for 90 days, or the credits are not enough to cover the interest debited during the previous 90-day period, or number 4, drawing power calculated on the basis of a stock statement which is more than 3 months old are deemed irregular. If such irregular drawings are permitted for a continuous period of 90 days, the working capital account will become NPA. Number 5, a regular or ad hoc credit limit which is not renewed or reviewed within 6 months from the due date of the limit will become NPA. Number 6, if there are a few or a solitary credits before the closing date, just enough to meet the technical norms of NPA, and however the account indicates inherent weakness on the basis of the available data, the account should be deemed NPA. Number 7, in case an erosion takes place in the value of security and the realizable value is less than 50% of the value accepted by the bank at the time of last inspection, the account will become NPA. Number 8, in case of a fraud being reported, the entire amount will become NPA if not already in NPA. So I just told you 8 ways in which a cash credit or an overdraft account can become NPA. Moving to the second part of fund-based working capital, let's talk about a bill discounting account. Every bill discounted has a due date on which the same will be realized by the bank from the customer of the borrower. A bill discounting facility will become NPA when the bill remains overdue for a period of more than 90 days from this due date. So this was about fund-based working capital. Now let's talk about term loans, including loans for projects under implementation. Ordinarily, every term loan has due dates on which the interest and or principal installments are to be repaid. These due dates are clearly documented at the time of the sanction. A term loan will become NPA when such a stipulated installment remains overdue for more than 90 days. Now, a peculiarity arises for projects which are under implementation, because for such projects, the repayment has not yet started, as the repayment is usually structured post the DCCO, which is the date of commencement of commercial operations. Hence, for such projects under implementation, the below guidance is applicable. Number 1. For defined infrastructure projects, if the DCCO and the associated repayment schedule is deferred beyond 2+1 years from the original DCCO, or beyond 2+2 years for projects involving court cases or arbitration, or number 2, any of the original terms and conditions other than the DCCO and associated repayment schedule are modified, or number 3, delay and consequent shift of DCCO is on account of reasons which are within the control of the promoters. In any of these 3 cases, if a defined infrastructure project loan is under implementation, it will become NPA. What do I mean by 2+1 and 2+2? So basically there's a total time period of 3 years, which is generally availed in 2 tranches, that is why 2+1, and in cases where there are court cases or arbitration, it is availed in 2 tranches of 2+2. So in any case, beyond 3 years and beyond 4 years, the DCCO cannot be extended. Now talking about non-infrastructure projects, which also includes commercial real estate, if the DCCO and the associated repayment schedule is deferred beyond 1+1 years from the original DCCO, or any of the original terms and conditions of the loan other than the DCCO and associated repayment schedule are modified, or delay and shift of DCCO is on account of reasons within control of the promoters, or for commercial real estate, if any of the conditions of the RERA Act are not complied with, then the account will become NPA. So this was all about fund-based working capital and term loans, how exactly these accounts become NPA. We discussed cash credits, we discussed bill discounting, we discussed term loans for projects which are under implementation, and term loans wherein the repayment has started. Now there are other general rules in respect of NPAs which I would like to discuss. Rule number 1, NPA recognition is always borrower wise and never facility wise. This means that if one facility, say a cash credit, becomes NPA, all other facilities of that borrower with that bank will become NPA. Rule number 2, in case of consortium or multiple banking arrangements, the NPA classification will be based on the record of recovery of the individual banks. Hence, it is very much possible for an account to become NPA with one member bank while continuing to stay performing with another member bank or the lead bank, and even vice versa. Rule 3. Let's talk about few advances which will never become NPA even if the borrower becomes NPA. A bill discounted under the comfort of LC, which is called a BULC, of another bank will not be treated as NPA when the borrower becomes NPA. Also, advances against term deposits, national savings certificates eligible for surrender, Kisan Vikas Patra, life insurance policies will not become NPA even if the borrower becomes NPA, provided stipulated margin is available. Once the margin becomes inadequate, this account will also become NPA. So hopefully the above discussion gave you good insights into the various ways in which you can become an NPA in the Indian banking and finance system. If you have any queries, please leave them in the comments box, and I will see you in my next video. Thank you.